Revelation Charlie Munger. Once we'd gotten over the hurdle of recognizing that a thing could be a bargain based on quantitative measures that would have worried Graham, we started thinking about better businesses. Benjamin Graham was the dean of value investing. He was also Warren Buffett's teacher and mentor, and in his world, value investing meant buying a stock at below its intrinsic value, which to Graham meant half of book value or at a very low price-to-earnings ratio. One could readily do that in the period of 1933 to 1965 if one worked hard enough at doing those kinds of bargains. The problem with Graham's investment philosophy was that it required an investor to sell the stock once it rose to its intrinsic value. There was no such thing as owning a company for 20 years or longer and letting the underlying economics of the business grow the company and lift the stock price. Charlie and Warren realized that some businesses have exceptional economics working in their favor that will cause their intrinsic value to increase over time. The common stock of these amazing companies really is a kind of equity bond that has an increasing rate of interest earnings attached to it. For example, when Berkshire started buying Coca-Cola stock in 1988, GURs are adjusted for splits, the company had earnings of $0.18 a share and was growing its per-share earnings at a rate of approximately 16% a year. Berkshire paid approximately $3.24 a share, which equates to a P or E ratio of 18, way too high for the likes of Graham. But Charlie and Warren could see something that Graham couldn't, that the long-term economics of the business made it a bargain at a P or E ratio of 18. They saw Coca-Cola's stock as a kind of equity bond, which was paying an initial rate of return of 5.55%. 18 EPS divided by $3.24 equals 5.55%, which would continue to increase as Coke's per-share earnings continued to grow, and that over the long term, the market would advance Coke's share price as the company's earnings grew. So how did Berkshire do? Its $1.299 billion original investment in Coke in 1988 over the last 27 years has grown to be worth $17.184 billion, giving Berkshire an average annual compounding rate of return of 10.04% for the 27 years, which doesn't even include all the dividends that it received in that time period. In 2015 alone, Coca-Cola paid to Berkshire $528 million in dividends, giving Berkshire a current annual dividend rate of return of 40% on its initial investment of $1.299 billion. Over the next few years, Coca-Cola will pay Berkshire approximately $2.64 billion in dividends. Things really do go better with a Coke, including our money.